as I'm sure you guys have realized, this channel is all about telling you how it is. I don't have clients, I don't sell products, I don't need you to be optimistic, nor do I need you to be bearish in order to make these videos. On the other hand, Wall Street makes a lot more money when people are bullish. If people think a recession is coming, they don't invest their money. It's quite the opposite of how people should operate, and that's why people opt to just use fund managers so they don't have to deal with this, because emotionally speaking, when you could lose money is the best time to invest money. When, you know, times are great, it's usually not the best time to invest money. But some of this shit is just too far gone for me. Like this individual, Chris Verone, that says industrials have been showing we're in a soft landing, but yet the employment component of the Richmond Fed Manufacturing Index broke its 2020 pandemic low. As of September, it's at its lowest point since April of 2009, and it looks like the manufacturing sector is about to start hemorrhaging jobs. Last I checked, industrials were part of manufacturing, but maybe something changed, I guess? Like, some of this stuff is just so far diluted, it's actually crazy. But as you know, I have been a big advocate of markets are going higher in the near term. That's just the way it is. Whether you like it or not, you don't want to be short this market. I'm not short this market. I do have a couple debit spread trades that are a couple $100 that are for the end of December of this year, just in case the economy weakens a little bit more in October, a lot more in November, and a lot more in December. Those will pay out, but it's less than 1% of my portfolio, like 0.5% of my portfolio, that is in any of these hedges. Might be a little bit less. So, like, I am fully exposed to this market. I do want to share this clip with you from CNBC that says, markets could be in for an everything rally, says EMJ Capital's Eric Johnson. Eric Jackson. Let me correct myself.
Investors look for opportunity. Joining us now is EMJ Capital founder and president Eric Jackson, someone who I know was happy that the Fed did double, right? The 50 basis point cut. You're in all these sort of high beta tech stocks looking for the Fed cut. So are you repositioning? Are you doubling down? What are you doing now?
Yeah, well, Sarah, you're a student of the Fed history, and so the last time that the yield curve was inverted for so long and then finally broke out to the upside the way that we've seen recently, in a benign economic environment where rates are cutting down, was August of 1982. And when that happened, and there was a stock market rally, which lasted 10 months. NASDAQ went up 107% over those 10 months. So I think we could be in for an everything rally. It's not just small cap tech, although that will participate. It'll be the Mag 7. It'll be other stuff too.
Like Bitcoin, which has gone up, gold is going up, commodities are going up. I mean, that speaks to the everything rallies.
I also want to share this clip with you that says it's all about growth to determine where stocks go next.
To our talk of the tape, where to find the best opportunities within this bull market right now. And let's ask our panel that very question. Adam Parker is the founder and CEO of Trivariate Research, and a CNBC contributor. Lauren Goodwin of New York Life Investments. Christina Hooper of Invesco. Welcome, everybody. It's good to have everybody here. You're still defensively positioned. So you said probably sell the first rate cut. Well, we got the first cut, but why are you defensively positioned? We've been hitting new highs here.
So the note that we wrote this weekend was there's nothing worse than being a consensus bear and being wrong. It's like the worst thing you can do is everyone's cautious coming in September, and instead of it being the self-fulfilling prophecy, it's like wrong. And there's some new news. Obviously, this China stimulus is a positive. Generally, when they do stuff, it helps energy materials and industrial. So that's incremental from maybe a few days ago. But I'm trying to take a step back and say, what do I believe is like a reasonable scenario for the economy and for corporate earnings? Can I stretch it to get sort of $300 in 2026 earnings for the S&P? Should I pay 20 times that? That gets me about 6,000. So, okay, I can see I'm paying 20 times 2026 earnings right now in a slowing economy while they begin to stimulate. Maybe. it's just really hard for me to walk in and say, I think there's like 10, 15% upside justifiably. So I feel like I can pick stocks in this environment more than I feel like I want to just, chase, what's been a massive rally.
Do you think statistically earnings tend to do better in a lower rate environment? Do stock prices tend to do better in a lower rate environment?
Yeah.
Is the answer yes?
It's more the latter where,
I'm asking you that because you have a PhD in statistics. I'm playing around with you a little bit, but you know what I mean.
Yeah, what I wrote in the note is I think there's a 90% chance earnings come lower and a 10% chance they come up, and a 50% chance the market goes up and a 50% chance it goes down. I know the earnings estimates are too high for Q4, and I thought FedEx and maybe, we'll see there's some bellwethers that are starting to show a little bit of squishiness, but on the other hand, I'm less confident that we just won't have more multiple expansion because there are some things that I could dream about that can cause margin expansion, particularly around productivity, AI deployment, et cetera. So
are we seeing that?
We are, and I think you'll see more of it. And I think what's in the price now is a pretty healthy rebound in the 2025 earnings and continued growth into 2026, and I'm paying a pretty chunky multiple on that 2026. I think it's possible. I'm not like saying, hey, short stuff, but I think, as we've been saying, I just don't know if I can believe 10% upside is more likely than 10% downside until I get a little bit more confident on how much the consumer's slowing. There's no question the consumer's slowing.
Let's just take it, Lauren, base level, right? Let's go back to the beginning of when the Fed does what it's doing, right? 09, we learned from 09, don't fight the Fed, right? Somebody came up with that at some point, and it's worked on both sides. They start hiking, stocks fell sharply. They start cutting, aren't stocks supposed to continue to rise? And isn't this a boost to stocks? That's what they say. Are they right?
I think in this circumstance, they're right for now. But the reality is that it's still all about growth where stocks go next. And it's actually true for profit margins as well. When the Fed is cutting historically, profit margins stay about where they are, earnings stay about where they are until growth slows. And so that's an environment where the equity market can continue trudging higher. But it's difficult to see the real economic catalysts that get us a real upstart in growth without inflation that the market would be happy about. And so I'm a buyer of this rally until unemployment claims start rising, until earnings start declining, really until growth's a problem. But I think we're going to see a really volatile market between those growth and slowdown narratives until that time.
We are trying to, Christina, make investment decisions in some respects based on historical precedent. You've heard, some of the commentary here and elsewhere. Well, when the Fed starts cutting interest rates, it typically does this, or back in 1990, whatever, this is what happened when the Fed was cutting interest rates. And I know you step into a big pile of what when you try and suggest that this is different this time. But this is unprecedented. Has the Fed ever started cutting interest rates at a time when the economy was as reasonably good as it appears to be today?
It is hard to find a place in modern times where this has happened.
By 50 basis points, nonetheless?
A crisis cut in a non-crisis environment. Absolutely. It's unheard of. And I think we have to recognize that the Fed is cutting into growth. Now, yes, we are going to see a slowdown, but I think it's going to be very, very brief, and that we're going to see a reacceleration. Not only do we have 50 basis points already, but we're looking out on 50 more this year and significantly more next year. In fact, if we listen to some of the FOMC members, we can expect more and more cuts. This is an environment, I think, where we're throwing a lot of jet fuel behind stocks. Now, it doesn't mean that we're going to see the stock market go crazy. But I do think, especially those areas that haven't had as big a rally, especially the cyclicals, where there is an expectation that if the economy does reaccelerate, they'll perform well. We'll see that. And what's happened today in terms of the China announcement is only helping that.
You got a good dose of the bull and bear argument from these two clips. What again, I find most striking, it was Adam Parker with Trivariate Research. He's the first guy that you heard there. He runs a momentum strategy, and I think the numbers to paper just kind of show there's not a lot of opportunity in the headline S&P. Even if things come in better than expected. But as that last lady was saying, there is some opportunity under the surface with cyclicals and small caps and some potential materials. Now that China's stimulus has started, you've seen commodities do very well today. But the underlying risk is of a larger slowdown in the economy. The risk is not that you miss the upside, but you're not prepared for the downside. That's the real risk in markets today. But in the near term, as New York investment strategist there was saying, markets can sludge higher or trudge higher in the very near term following this rate cut from the Fed. Because Wall Street is so disproportionately screaming soft landing, that is enough to continue to see stocks move higher. And there were a lot of opinion pieces thrown in there as well, like the last lady that said, she thinks it's going to be a shallow and fast slowdown, right? Or it's not going to last long. That's really an opinion piece. There is nothing in the data or the facts that support that. And in fact, to the latter point that the host there was making, usually when the Fed cuts rates is when you want to be out of stocks. It's not when you want to go in stocks. It's not normally when stocks rally. When the Fed cuts rates, stocks tend to crash. Historically speaking, they can go up for a little bit. Okay, 2007 was a great example. And yes, they are wrong. The last time Fed cut rates 50 basis points was September 18, 2007. Stocks went up, but the economy looked just fine at that point. It was the same kind of, situation we are in now, where yes, things were slowing. Economy looked fine overall. And the Fed gave us 50 basis points. Stocks went higher. Eventually, the problems came out a couple months later, and we've seen a larger crash. Like, this is the 2007 Part 2 rerun all over again. Question is, do we have that catalyst? Do we have that deep recession or not? And I also think it's pretty safe to say when the bulls start to flip, the markets could fall rapidly. Okay, this could be a 1 week or 2 day kind of thing where you all of a sudden get everyone starting to flip to the recession camp just with a single data point or two. Imagine if the unemployment rate goes up again or goes up a lot. Then you're going to have a lot more people that start to join that bearish camp. And then, from that point, markets would likely fall. Now, for the rest of this week, we do have some important data coming out. Tomorrow morning, we don't have much. You have new home sales month over month and for the month of August. If this slows down, I think this could actually start to be important for the economy. If homes are just not moving, right? We've seen a lot of supply enter the markets. Homes listed is up almost 300% since February, March of 2022, whereas the applications to purchase a home are not budging. Okay, refinances are starting to move up, but to purchase a home, they're just not moving at all. And I think that could start to be an important thing to look for in our markets. If housing were to roll over here, yeah, that's going to catch everyone off guards. Now, for Thursday, you're going to get durable goods orders month over month. You're expecting negative 2.6%. That sounds bad, but last month was positive 9.9%. So negative 2.6% really wouldn't be that bad in the grand scheme of things. Okay, so if that number comes in like negative 4%, negative 5%, that's going to throw a little bit of cold water potentially on this market. You will get the GDP growth rate quarter over quarter. Final numbers for Q2 expecting 3%. The last number we had was 1.4%. So expecting really good GDP for Q2 on Thursday. And then you do get a speech from Fed Jerome Powell Thursday at 9:20 in the morning. I think Powell's going to be very bullish. He's going to try to talk down Treasury yields, in which the Fed's 50 basis point cut did not do that. Treasury yields actually went higher on on the 50 basis point cut, which was not what the Fed, I think, wanted to see happen. And then as well on Thursday, pending home sales month over month, year over year. A bunch of other Fed speakers as well will be speaking. Fed Collins, Fed Kugler, Fed Williams, some ECB Fed speakers, Fed Barr, right? The list kind of goes on and on. 11 o'clock in the morning, you will get Kansas Fed Composite Index and Kansas Fed Manufacturing Index. I think manufacturing is really an area that we want to watch right now because it looks like manufacturing or just factory jobs in general are starting to be hemorrhaged, like at an aggressive pace, okay, via some of the latest data points that we have gotten. And that could start to be very problematic, especially if we see more signs of weakening there. And then on Friday, you will get PCE month over month. As Fed Waller suggested about a week ago, this could come in a little bit on the light side, around 0.1%. Consensus is 0.2%. I don't think PCE is much of a catalyst anymore to our markets because it's running so low. But if you start to see PCE rise or something, then the markets are not going to like that. Personal income month over month, we want to see that go up because we're not concerned about the whole wage price spiral thing anymore. I never was really concerned about that. But if wages start to go up more than expected, that's actually going to be a really good sign, because if wages go up, then people can start to catch up to the cost of living that has well outpaced inflation, like trueflation, the cost of food and baby formula and diapers, or really anything you need to live on, is way more inflated than the government numbers tell us. So if incomes start to rise more, that's actually going to be a really good sign. Personal spending, I think, is one of the biggest data points, if not the biggest data point of this week. That comes out as well, 8:30 in the morning on Friday. You're expecting 0.3%. Last month was 0.5%. So that's not terrible. It's not great. If we get a downside surprise there, that's really not going to be good. Now, my expectation is, I think September, I'm really not concerned about the economic data. I've said that before in videos, and that's why I think markets will do well. October, I think, is going to become a little bit more mixed. I think you're going to start seeing some of what we're actually seeing in the economy reflected into the economic data. I think, in other words, October's economic data is probably going to be reflective of what we've seen in August or late July in the economy. So October is going to be a little bit more mixed, and potentially we'll get that election correction. And then November, December, January, February, March, that's when things could get a lot dicier, potentially to the downside. And that's my timeline. That's what I believe. But again, in the near term, markets can go higher, and I do expect that they will. My thoughts that I'm sharing with you guys. I do think it's time to be defensive, to raise as much cash as possible, because again, even if things go better than expected from now until 2026, you've virtually priced all of that in already. The risk is things are not as picture perfect from now over the next 12 months. And you do get a much better buying opportunity. I think a lot of people fail to remember it's not about when you sell a stock in terms of you making money in markets. It's vastly more important when you buy a stock. Take Cisco for an example. If you bought Cisco before the thing went crazy, the darling of the .com bubble, you've still done very well. Okay, still to this day, you've done very well. Okay, like if you bought this sucker in 97 for $4 per share, you're still up over 1,000% today. If you bought this thing at $56 at all-time highs, you're still negative today. 25 years later. Do not be the guy that paid the wrong price for the wrong stock at the wrong time. And I think there is a growing risk that people are doing that. Even if you're not down 25 years, I think there's the chance that you could be down for an extended period in time. And it's not the best situation I think a lot of people are wanting to be in. So let me know what you think about this information down below in the comment section. It's just a balance of risks, and I think the risk is more downside than upside here at this point. But in the near term, markets, they're going to go higher, no matter who likes that or who doesn't. So I don't think now is the time to be, shorting markets for the recession crash. I think that is November, December, January, February, March, some point in those 5 months. So yeah, you guys have a great rest of your day, and I will see you in the next one.